Fed Chief Jerome Powell has spoken. What is going to happen after the Jackson Hole event? We're going to discuss everything of this incoming flood of liquidity right after the intro. Stay tuned. Hello and welcome to yet another video from Broombridge Capital. My name is Patrick and I have my esteemed colleague Henrik sitting next to me. We both did listen to Fed Chief Powell's speech around the Jackson Hole event. And so far, we are more or less flabbergasted. I think we were really hoping for something that would give us a clear direction. However, we were not really convinced by his words. To sum it up for you guys, it was simply that he sees risks in the labor market because the labor market has been weakening quite a bit. And this is also showing in the data. And then there is creeping up inflation where we might get an inflation problem later down the line if he lowers rates. So what does he do? To stabilize the labor market, he's going to lower rates and ignore inflation. In my opinion, this is very much not something that you would like to see if you want the economy to be strong, because the economy, obviously, because there's no job market growth at the moment, is weakening. We are actually at half of the gross domestic product than we were a year ago. Therefore, we are trying to cut rates into a weakening economy and with inflation risks on the rise. Therefore, this could spill a lot of disaster, in my opinion. But what does it mean in the short term? Well, in the short term, there is a couple of effects that this is going to have, mainly the rate cut, and the market has shown it to us by simply going even higher. However, let's highlight a little bit of things that this might implicate here. Henrik, what is your opinion? What did you get out of the speech and what does it have on implications around the American economy here?
Well, Powell at the moment certainly is in a very tough spot. While it is true that the labor market is near maximum employment, with employment rate actually sitting below target, and in the meantime, inflation is sitting above the target, you actually have to look beyond these numbers. Because while employment rate is actually still stable at the moment, this is not really due to good growth, because job growth has slowed tremendously. And the only reason why employment rate is still stable is the simultaneously lowering rate of immigration. So job creation is actually down, but so is the growth of the labor force. The risk of the labor market imploding here has risen tremendously. This means that we do not have the luxury of waiting to see worse numbers, because once they are worsening, it will come in a big wave of layoffs. So Powell has to preemptively change the monetary policy of a more restrictive one. But inflation is also still very tricky. It is sitting above the target, but at the same time it is down since the pandemic. But still, we do have some changes in tax, spending and regulatory policies that will influence inflation greatly. And there's a lot of uncertainty here, especially when it comes to the topic of tariffs, because tariff effects are still coming in and haven't fully played out and worked their way down the supply chain. So we should still see some inflationary effects coming in from these tariffs over time. So at the end of the day, whatever the Fed does, the situation is looking a bit bleak. If rates stay the same, we could get a collapse of the labor market, and if rates increase, we could get a big inflation wave. But at the end of the day, the Fed has put the first steps in motion towards lowering interest rates. On one hand, Powell has stated that the current outlook may warrant a change in policy stance. On the other hand, the Fed has taken a step back from the rigid 2% inflation goal, which is obviously a setup for future rate cuts. But now the question stands: when will this rate cut occur? A lot of people are very focused in on the September rate cuts, but we have two more opportunities for rate cut coming this year. One is in late October and another one in early December. I personally am pretty sure that it is almost guaranteed that we will get a rate cut this year. Now, whether it will be in September or maybe even October or December will depend on the numbers of the labor market that are coming out in September right before the Fed meeting. So if the labor market is showing more signs of weakness, we will get a rate cut. But if it is still holding on, then I think Jerome Powell would prefer to push the rate cut more into the future to October or maybe even December to wait out the effects of the tariffs until they've fully played out.
So what does that mean for me as an average American investor? What should I expect from this, regardless of when the rate cut comes?
So regardless of when it is coming exactly, it will be coming this year. And the effects of that will most likely be, on one hand, further inflation, maybe even a big inflation wave, and obviously a lot of money coming into the market, which should lead to exploding asset prices as well. So what would you say is the best way to navigate the situation?
Well, of course, owning assets is the first thing, because if something is devaluing your currency, you could bet against that by just hedging yourself with stocks, real estate, cryptocurrencies, and ETFs. However, we feel that most of the big chunks of most asset prices have had a huge run since 2021, and they did continue to rise. So I think the buy and hold approach is going to become less important, because one thing is clear: the can has been kicked down the road quite a bit, and it has been happening in the past as well. However, this time it's being kicked towards the edge of a cliff. So I wouldn't be surprised if around the end of next year, or maybe even mid-year next year, there's going to be an inflation problem that we haven't ever seen before. Therefore, it is very risky to be a buy and hold investor, since buy and hold will not really help you when everything is hitting the fan. Therefore, it is better to actively manage your risk right now. We do not believe that blind ETF investing from month over month is going to help you here, especially if you have been investing in the S&P 500 or even the MSCI World. You wouldn't have seen positive returns this year, because most of the buys you would have conducted would have been down significantly, and you only had a month, maybe a day, to buy the lower prices. Therefore, a buy and hold approach this year hasn't really worked. And in our opinion, this is going to be continuing to be the problem for most investors, as we feel that more active management will be required in the future, because the landscape is going to toughen even more. If there's lots of inflation and there's low rates, the market is going to turn crazy, and opportunities are definitely going to be rare. If you need help with that, we actually make it easy to invest and actively manage your portfolio by providing you the right information to make the best decisions possible for you. With our analysis, we cover over 180 assets across the S&P 500, the Nasdaq, gold, silver, Bitcoin, Ethereum, and many other altcoins. You sure as hell don't want to miss out on our information, and you can find everything down below in the description with a link to our free Discord community. There, we answer your questions, and if you like, you can subscribe to our premium group to receive all the thorough analysis that you need to succeed in the markets. Hopefully we speak you there, and we hope you learned something new in this video. If you did, please leave a like, share, and subscribe to our channel. This is Patrick with Bloomberg Capital. I wish you a good week. Until next time.
Here at Bloomberg Capital.